All right, let's just jump right into this explainer and decode exactly where global money is flowing right now in the summer of 2026. We're looking at a genuinely fascinating financial landscape today. It's this unique moment where massive, sweeping macroeconomic forces are literally colliding with the ground-level realities of tech innovation. We've got a great roadmap for you today. We're going to cover macro forces in central banks, the AI earnings test in public markets, the AI funding surge over in private markets, crypto's cautious resilience, and finally, wrap it up with key takeaways for investors.
So where exactly is the smart money going in 2026? Look, with fluctuating oil prices and the initial AI hype facing a pretty serious reality check, we really have to ask ourselves how these dominoes are falling. Where is capital actually seeking shelter, and where is it taking calculated risks? Let's find out.
Starting things off with Section 1, Macro Forces and Central Banks.
Okay, I want you to notice this single absolutely crucial number, 3.75%. That's where the benchmark U.S. Fed funds rate is sitting right now. And it tells us a lot, right? It reflects a cautious, but incredibly firm stance from the Federal Reserve. They're seeing a U.S. economy that's still expanding at a solid pace, with moderate household consumption and steady manufacturing output. But make no mistake, they are definitely keeping their foot heavily on the brake. And this quote from Fed Chair Kevin Warsh brilliantly illustrates the mindset at the top. He said, "If we get policy right, and we will, the inflation surge of the last 5 years will be a thing of the past." This shows us that policymakers have zero tolerance for persistently elevated inflation. They are strictly committed to that 2% target. So even though they see strength in business investment, especially all that spending on data centers and AI equipment, and a job market that's holding up, they are absolutely not letting their guard down when it comes to price stability.
Now look at this timeline over the last 17 months. It shows exactly why those inflation worries are roaring back to life. About 6 weeks ago, crude prices started touching new highs thanks to Middle East tensions, and this is directly pushing short-term U.S. Treasury yields to peaks we haven't seen in 17 months. Traders are actively wagering that the Fed might need to act on rates sooner rather than later just to combat this energy-driven inflation.
And let's cross the Atlantic for a second, because the European Central Bank is feeling this exact same heat. While they're expected to hold rates steady for the moment, they're keeping their options wide open for a potential hike this September. The escalating Iran crisis is essentially acting as a huge potential energy shock, and the ECB might literally be forced to adjust rates to prevent a broader price spiral. Meanwhile, you've got the euro actually rising toward a one-week high at $1.1429 ahead of these decisions.
Moving right along to Section 2, Public Markets, the AI earnings test.
Saxo's chief investment strategist Charu Chinana made a really brilliant point recently. The public market mindset has completely shifted. We're no longer looking at an AI demand problem. I mean, everybody knows the demand is there, right? Now we're looking at an AI return problem. Investors are heavily scrutinizing whether all this massive capital expenditure being poured into AI is actually generating enough returns to justify these sky-high valuations.
Because of this shift, we're seeing a massive divergence in the public markets. On one hand, the foundational layer of the AI boom is still totally roaring. Asian chipmakers like SK Hynix and Samsung are surging, boosting South Korea's Kospi by over 3%. But then look at the broader indices. The Indian Nifty 50 opened below 24,000, the Sensex shed over 350 points early on, and US Nasdaq futures dipped 0.1%. So, the broader market, yeah, it's feeling pretty nervous right now.
So all eyes are glued to this crucial slate of corporate earnings. Investors are watching Alphabet to see the real impact of their AI spending. They want Intel to provide a clear direction for the semiconductor sector. And for Microsoft, Meta, and Amazon, people need absolute proof that their pace of profit growth actually matches their huge valuations. Over in India, IT giant Infosys is in the hot seat for its Q1 FY27 results, with everyone looking for commentary on U.S. banking and financial services demand. Honestly, it's the ultimate show-me-the-money moment for public markets.
So if public markets are showing all this hesitation, where's the venture capital going? That brings us to Section 3. Private markets and the AI funding surge.
Well, the answer is firmly in the private sector. Take India, for example. VC funding there experienced a massive surge, hitting $431 million across 23 deals in just the third week of July 2026 alone. That is a huge rebound from a subdued $107 million just the week prior. In fact, it marks the fourth highest weekly funding for Indian startups this entire year. And, no surprise, AI startups are absolutely leading this charge.
Just look at these recent funding rounds. You've got the B2B platform Udaan pulling in $160 million, but right on their heels is the AI firm Emergent securing a massive $130 million round from major investors like Khosla Ventures. Even niche AI applications are getting in on the action, like QuickClean raising $14 million to expand their AI-driven laundry services.
The big takeaway here is that private investors are aggressively betting on AI to solve real-world problems. While the public markets are hyper-focused on quarterly returns and macro jitters, venture capital is looking way past the immediate horizon. They're incredibly confident that AI integration is going to reshape entire industries from the ground up, no matter what the stock market does today. Next up is Section 4, Crypto's Cautious Resilience. Let's see how decentralized assets are reacting to this super complex macro environment.
Despite all the headwinds we've just talked about, Bitcoin has demonstrated some pretty remarkable resilience, climbing back towards $64,700 recently. It's really holding its ground in what is undeniably a very turbulent sea.
This dynamic perfectly illustrates how crypto acts as a global barometer for risk. It's basically caught in this massive tug of war right now. On the bullish side, you've got underlying hopes of softer U.S. inflation easing some of those Fed rate hike concerns. But pulling hard in the opposite, bearish direction, you have escalating U.S.-Iran tensions and some very noticeable ETF outflows.
So across the broader digital asset board, we're seeing exactly what you'd expect in a tug of war, cautious consolidation. Bitcoin is down slightly, slipping about 0.5% while consolidating near that $62,000 to $64,000 range. Ethereum and BNB are posting very slight fractional gains. Investors here are clearly avoiding aggressive bets. They're choosing to wait on the sidelines for clearer macroeconomic signals from those central banks we discussed earlier.
All right, let's pull all of this together in our final section, Key Takeaways for Investors.
The roadmap for navigating the rest of 2026 is actually pretty clear. Step 1, you got to watch the central banks closely. Geopolitics and oil prices are keeping inflation risks alive, and that is going to dictate everything the Fed and the ECB do next. Step 2, scrutinize those tech earnings. The public market is totally past the hype phase. You need to look for actual AI profit generation, not just massive capital expenditures. And Step 3, monitor those VC flows. Because while public markets are wavering a bit, private capital is confidently pouring hundreds of millions into startups that are actually integrating AI into real-world business models.
So, to wrap things up, from high interest rates to tech earnings and crypto consolidation, 2026 has rapidly become the year of show me the returns. As the market demands real, tangible results, are we entering a new golden age of AI or just the end of the hype cycle? I'll leave you with that provocative thought to ponder. As these global financial dominoes keep falling, keep your eyes on the data, watch the markets, and as always, keep learning. Thanks for joining me for this explainer.